I've been thinking a lot about how the impact of the global pandemic this year, 2020, is going to shape financial services going forward. I have been thinking about topics such as non-performing loans, the strength of the banking system, and the nature of capital itself, how that's going to be evolving over time. Interestingly, my conversations with many different people in financial services, revealed that many people in the industry seem to think that the future is going to be a lot about more of the same. And very few banks, very few governments talk about the fallout that is coming to us from the pandemic, the need to regrow economies on the strength of the local communities, as well as the non-performing loans and the damage to capital that needs to be captured and quantified in order to help us make sense of the issues that we need to deal with going forward. I've been very fortunate to be able to run into, almost in a digital sort of way, with Bikram Chaudhury, who says that his business is to start looking at the non-performing loans of all the fintechs, the startups, the peer-to-peer lenders, the so-called microfinance credit players that are going to be throwing up into the marketplace and create an industry around these distressed assets that are going to be surfacing as a result of the pandemic. So I've invited him for a conversation. And the most interesting part of Bikram's profile is that he says that he's a recovering investment banker. So let's start with that, Bikram, and start by giving us a sense of who you are and how and this new opportunity you're in the process of creating for yourself as a result of the pandemic.
So much, Emmanuel. Thank you for the invite. I run a startup called GreenArc Capital, which focuses on impact lending. I've spent my career in top-tier investment banking firms, the last of which was Credit Suisse, where I spent 15 years across Hong Kong, London, and then Singapore. Prior to that, I was with Deutsche Bank, and before that with Bankers Trust, which was actually taken over by Deutsche Bank. The focus of my career has been on large-scale capital markets. So in other words, the movement of large sums of capital facilitated by capital market transactions in fixed income, which encompasses, the entire structured credit space, the illiquid lending space, and of course, the classic credit lending that banks do. GreenArc was founded with the premise that capital needs to move beyond one metric only, which is the financial return metric, right? The world of impact investing is looking to capture not just financial returns, but also social capital returns, and you can define them in many different ways. People call it ESG, which is the environment, social, and governance metrics. And impact looks over and beyond that as to what positive effect you are having on the world when you deploy capital. So our focus in the space is actually on two areas. One is we finance conservation, primarily of rainforests, which is a very difficult thing to do because of the lack of metrics around such an activity. And the second is financial inclusion, where you look to, the classic micro, which started with microfinance, and we look to bring institutional capital into these segments, so as to bring capital to the base of the pyramid of emerging market economies and poorer countries. GreenArc does this via technology-enabled platforms. We have a tech solution in place that allows us to deploy into micro-lending portfolios and easily scrutinize credit and impact.
So GreenArc Capital would I describe that as a boutique investment firm? Do you do any underwriting at all? What is your asset under management right now?
We are not a licensed asset manager. We are, in the last stages of our MAS of our MAS CMS licensing as a P2P fintech, which allows us to offer product to accredited investors, not to retail. However, our platform itself is not geared towards crowdsourcing or crowdfunding of that nature. We work primarily with institutional investors, i.e., large funds or large banks, in order to evaluate and better and better capture the risk and returns around the capital that they deploy into the space, right? So our tech platform is actually a look through that enables large volumes of loans, of micro loans, to be validated and credit rated at the loan by loan level. That's one. And secondly, we also run an impact analysis which allows each loan to, so we calculate impact at the loan level, which is something that is very rare, and actually we don't know anyone else who does this. Now, what tends to happen in impact investing and also in ESG investing is that market, this new asset class, hasn't really kept up, with the needs of institutional capital, right? I look at the impact and methodology as credit rating prior to credit rating agencies being ratified or being enshrined in regulation. So if you think back, when credit rating first started, people there were a number of methodologies, there were a number of players, each of whom claimed that their credit rating process was better than the others, and there is no very few common standards. Now, secondly, if you look at any impact fund, microcredit fund, the way that impact is measured and reported is post fact. So typically, you would have the equivalent of the sustainability reporting piece, right? So you'll have an impact report that is generated by the said asset manager or the said institution that then reports the metrics that they think are valuable in evaluating their portfolio. However, this is always done post fact on an annual basis. And a lot of the numbers are actually consultant driven. So they send consultants or auditors into the field who then estimate the impact that has been had, i.e., number of kids educated, gender equality in the portfolio, and so on and so forth. So when we started GreenArc, we took this problem and we reversed it. We said, how can we create this for ourselves or for our investors that kind of eliminates all these processes? So what we did was we use the data tape that is used in lending portfolios, right? We use that data tape to actually read off most of the impact metrics that we tabulate. Now, it is important to say that we do not have our own methodology, right? We follow, the taxonomy for impact is today maintained by a nonprofit called GIIN, the Global Impact Investing Network. They publish a taxonomy of impact metrics that you can capture as an impact investor. However, they leave it to every specific impact investor to develop the weightages and the metrics that are required, i.e., that's a vast field of metrics, and they say it's up to you to choose whichever metric you require. So think about it as, like, I would say, as financial reporting or ratios. Like, so you have a number of ratios, but you can choose from your perspective which ratios are relevant to you as a bank or as a trading company. It's very similar in the impact reporting space. But our methodology is, we worked with steering group within Impact called the Impact Management Project, which is again a non-profit. It's actually funded by a number of institutional funders. They publish recommended methodologies. So we are part of that, let's call it, cohort of people who work to publish common standards, right? So it's very early days in impact. The reason I'm giving you all this color is because ESG and impact washing has, there is a certain cynicism about how these processes work at the institutional level. People are like, you can report anything. It's all kind of impact wash anyway, right? From a tech perspective, that's our tech solution has eliminated that issue, not entirely, right? But, we have ensured that for the borrowers that we work with, and for the portfolios that we work on, these numbers can't be kind of made up, right? There is a certain check and balance. The second thing we do is we also use data science to tabulate and do what I would call category one checks on the data that we gather. For example, if there's a portfolio of SMEs in Indonesia, right, and one SME is reporting a 30% female employee ratio, right, we would then tabulate it to the metrics that we know for that particular country or that region or even that area. So 30% sounds good on the face of it, right? But when you look at Indonesia, actually the average SME employs 37%. So this is actually underperforming. So you have that sense check that that goes on at that level. So this is the impact side of it. And of course, on the credit side of it, we use alternative credit scoring, and but we actually stay more at the traditional credit level. We have a partnership with the NUS and their Asian Institute of Digital Finance, via which we pull on the large credit database that they have to be able to credit score the portfolios that we originate, right? So again, from a methodology perspective, what we'd like to say is that we don't actually create our own methodology. We work with investors based on the data that they require to feed them the required impact data, right? And on the credit side, of course, we do, the scoring that we do is validated scoring, right? We don't use a proprietary algorithm, right? But we supervise the lenders that we work with and check on the credit scoring via third-party measures.
To complete the profile, how many portfolios do you have? What is their size and how many customers? And then on the investor side, are you actually working with specific investors using the platform that you've created?
We work in the private space. We haven't gone public with the platform, right? But we have 14 lenders across Southeast Asia that we work. Now, when we say lenders, I mean the last mile lenders, like the institutions that actually lend the portfolio, right?
Right.
And on the institutional side, we work with like two large institutions for their deployment of capital.
Do they buy your portfolio eventually, or are they still just investors?
They eventually finance the portfolios, right? Now the nature of the financing will depend on let's call it the jurisdiction or the credit worthiness of the portfolio, right? So typically, lenders always keep a certain amount of skin in the game with the portfolios, right? So it's not 100% pass through, right? So and that subordination depends on the comfort level that the lending institution has with the microfinancer or the fintech.
Okay, so you're a fintech working with fintechs.
That is correct. Yeah, you can think of us as a fintech, or as a fintech of fintechs.
So, what is your sense of the, how the whole P2P and impact and inclusive lending business evolved as a result of the pandemic? What's the scenario out there right now?
The impact, to put it mildly, has been brutal, right? So very few lenders, whether new or old, right, have come out positively out of this pandemic, or actually in the pandemic, because we're not out of the pandemic yet, right? Yeah. And you've seen you've seen lenders fail. You've seen loan books shrink substantially, sometimes to the nature of 80%. You've seen massive de-risking of balance sheets. So not just fintech lending, not just P2P lending, but you've seen de-risking of regular balance sheets as well, right? And of course, you've seen entire sectors crater, right? Tourism, hospitality, the entire travel industry, all what I would call growth sectors in classic emerging market economies. You've seen all these sectors kind of nosedive and go into distressed asset land. Not because obviously of any fault of their own, but something like a pandemic is very much a macro event, right? And it impacts everything down from, once the demand dries up, then everything up the supply chain kind of suffers. The simple fact that the global economy is expected to contract between 5 to 8% this year, right? Yep. So and And that means that 100 million people are going to be pushed into poverty this year. But when you look at this, 100 million people, right, you can see here that, 80% of the people falling into extreme poverty or below the poverty line, right, are obviously from poor and middle income countries, right? Not the rich countries as such, because they have strong safety nets, they have strong relief programs, like for Singapore or for Europe. But of course, when you go to India, Indonesia, or anybody else, well, guess, there's not much of social backstop, right?
Yeah.
And of course, COVID-19 has a disproportionate impact on populations, right? With the most socio-economically disadvantaged segments taking the brunt. People talk a lot about K-shaped recoveries and, recessions, right? This is very much what you see here, and what people are talking about is very much the K-shaped. In other words, if you're a white collar employee, okay, there is some disruption to your life. To a certain extent, business does continue, right?
Right.
However, if you're a blue collar worker, I mean, the impact on your livelihood and your work is substantial for the pandemic, right? Your factories close down. If you work as a tourist guide, you can forget about business. If you are, if you're anywhere near, on a daily work basis, you can imagine the impact that's had, right? So this is very much what's happening in the world out there. This is now just a bit of an Asia focus, right? Of the 100 million people that, globally that will go into poverty this year, approximately 38 million are East Asia, which is, excludes South Asia. And then if you look at the graph, right, these are the percentage of share of households with lost earnings in the crisis. And again, you can see that there's a disproportionate impact the poorer you are as a country. The Myanmar, you have an 85%, 85%, let's call it, impact on households, right? Indonesia is very close to 80%, Cambodia 80%, and so on and so forth. Okay, so again, coming back to the thesis that the impact is disproportionate on poorer countries. Now, this is something that everyone knows intuitively, is that a pandemic increases inequality massively, right? And actually, you know, if you look at the numbers, and these are IMF numbers, they estimate that the gains in inequality that have been achieved, right, since 2008 are going to be wiped out totally in this 1 year. Right? So, in other words, 10 years of progress are going to be wiped out in 1 year. And welfare, of course, is again one of those difficult to estimate indicators, like welfare of an individual or welfare of an economy. But the IMF has taken a stab at it, on, as you can see with the graph on the right hand side. And you can see here that the welfare decline, has gone from is actually, there's a substantial impact, and the only mitigant to the poorer quality of life is your ability to telework. In other words, what you and I are doing right now, right? If you have that ability, there is a certain cushion. The blow to your earnings, or to your to your income, or to your quality of life would be reduced, right? However, if you are, for example, in a rural area, or you're being educated in a school with no internet facilities, guess what? That's not a mitigation that you can count on.
I've seen the rise of impact investment, of microfinance, of inclusive finance over the last 30 years or so. And you have the origins of Grameen Bank, for example, and so on, originating the industry. And a lot of that origination had to do with being very sensitive to the nuances of the local communities. In the case of Bangladesh, it was women working in groups which were very sustainable and so on. And when these models were extended to, like countries like India, where the private equity guys came in, and the venture capitalists came in with hot money from the US, mostly using the same terminology, inclusive finance and microcredit and so on. They found that it didn't work because they were trying to deploy hot money, and secondly, they weren't sensitive enough to the the profile of the communities that they were serving. So if they were serving migrant male population living in on the outskirts of the city, in slums or migrant locations outside the city, the credit profiles, they change. They're dramatically unsustainable, and so on. So deploying inclusive finance in emerging markets required us to be very sensitive. And now, what you are involved in is the second half of the business, which is collections, which is credit quality, and sustainability for the long term, right? And of course, the economics of the Gini coefficient, the disparity between rich and poor, and so on, and the availability or the access to capital, to income, and so on. So I'm very excited about what you're doing, because you're now seeing the second half of the equation. And you said, you have alternative credit score models that you use. And on top of that, you have the fact that many governments have been very prescriptive and very stringent with peer-to-peer lending. In fact, one of the reasons peer-to-peer lending is floundering is because of regulation being put in place. In the US and in the Western world, peer-to-peer lending has found a niche, which is, it's like actually more subprime lending below a very highly banked population. Whereas in the countries where peer-to-peer lending seem to have a better story to tell, in developing countries, but there the problem is regulation and so on, right? So talk to us a little bit about the space that you're playing in, and what are the regulation of the space that you're playing in, or what are the operating premises of the space that you're playing in.
So as you know, household credit to GDP, right, is a good indicator of banking and financial inclusion penetration in a society. When you look at the developed market, right, typically household credit to GDP, right, is about at 80 to 100%. When you look at it for countries like Indonesia, the Philippines, or India, right, that number is 17% for India, it is 12% for Indonesia, and it is 10% for the Philippines. So as you rightly said, fintechs in developed markets have found their niche below this pyramid, right? So there's banking going down, there's mortgages, there's regular credit card assets, there's I would say bank lending, and below that is where the fintechs operate, right? They look at the margin, they look at the guys who have been rejected, and and MSMEs that have been rejected, and look to give them credit. That is not the case in emerging markets, right? In emerging markets, when you take an Indonesia or a Philippines or an India where credit penetration is still in its teens, right, you can see that there's still a lot of low-hanging fruit for lending institutions. Okay. Now the issue, of course, is how do you penetrate this? How do you scale these lending models, right? How do you ensure that you're taking the right credit decision? How do you look at it from a cultural and a community perspective to ensure that what you're doing is sustainable, right? And that you are in conformity with let's call it social norms and or what the society expects out of capital deployment. Now, obviously, the regulatory space has really played second fiddle to this. Regulators tend not to be the most responsive of let's call it of advocates for this space, and so you've seen, I would say, even new lenders with innovative models struggle in the area. Now, why does that happen? You can't really blame the regulators, because they've been colored by by various crises, right, that has happened in respective markets, right, where they've seen kind of new models come and go, and and seen I would say misrepresentation and fraud at a massive scale. I would pin down the issues around the regulatory environment to prior bad experiences, in other words, credit crisis, and secondly, a lack of faith in their own ability to govern and stay on top of these new lending models, right? So even as regulators, the institutions lack faith in their own ability to be able to monitor risk at the institutions level, right? So what you see is that even if new institutions are given licenses, they tend to get, especially in India, they tend to get buried on the paperwork, from a regulatory perspective, and find it very difficult to do their businesses. And or two, they're denied licenses or denied, let's call it operating freedom to be able to fulfill the original premise. So I won't blame regulation as what, I'll say that they're colored by their previous experience, and they also, because they're not as tech enabled or not as forward looking as the new breed of lenders, they find it very difficult to allow them to operate without what they consider adequate supervision, right? They don't have the comfort of supervising these new age lenders, right? Whereas if you think about it from a developed market perspective, I think a lot of the regulators have taken the view that these are not too big to fail yet. They operate at a scale where they're experimenting, and it's fine to have, a few, let's call it a few mix-ups, etc., just so that, to see if there's something innovative comes out of that, right? So I think it's a bit of an attitudinal change as well, right? And of course, you see that across the region. For example, Vietnam today still does not have a proper digital lending supervisory policy, right? Even now, right? Even now, the fintechs are regulated as pawnbrokers or old style money lenders, right? So there's definitely this gap, I would say, between governance and where the market has gone to, right? So I see this as a call for the supervisory institutions to modernize, right?
Okay.
Rather than kind of that, oh, they are holding back. I think the faster the regulators get their act together in how they monitor and enable technology lending, the better it will be.
So if you're not a fund manager, what is the role that you play, and who are your clients, and how are you onboarding them?
So we work today with institutional investors, right, who are and we act as advisors to their lending, because we are not licensed to intermediate these pools of capital, right? But we help them in the origination and the risk analysis and the credit analysis of their target lending. Right?
Okay. So they buy the portfolio themselves directly.
Themselves. That is correct.
Okay.
We're not a balance sheet player. So the institutions that buy these portfolios, actually, large family offices, okay, specifically in the Europe and the US, who have defined their own impact lending mandates, right? So you have today a number of large pools of capital that look to deploy capital with impact objectives. So we work with these investors, right, to deploy their capital in line with their own impact objectives. In the family office space, the preferred alignment is to the UN SDGs, the Sustainable Development Goals. And again, the way that these SDG alignment is achieved is via the impact metrics. So this link sounds tenuous to you, but at the same time, once you have the impact metrics mapped at the core portfolio level, it's quite easy to look at, for example, how much contribution are you having to gender in your portfolio, how many additional women are you being employed, etc. So the entire process is mapped down, and therefore these investors can look at what they want to achieve and look at how well those lending portfolios are achieving these goals.
And what sizes are we talking about?
Typical transaction would be between $5 to $10 million at the micro institution level.
Would I argue that the cost of managing a distressed portfolio or an impact portfolio is higher than that of a traditional portfolio?
I would say, intuitively, you would say yes, intuitively, right? However, that's the precise nature of having a tech-enabled platform that automates these requirements, right? So one of the big issues in the microfinance, financial inclusion lending, and the impact space is the notional size, right? So what you find is that the more you can reduce the per cost transaction cost, the more you can facilitate smaller transactions that are more impactful. So
Yeah.
the entire premise behind having and that's why we call us as a fintech, is having this process tech enabled, is that it allows you to scale and keep your cost per transaction down to competitive levels, right? So, for example, in a large institution like Credit Suisse, the cost of onboarding a client, just the KYC and onboarding any kind of client, is something to the tune of $20,000 to $30,000. And this is ignoring the let's call it the lending cost and the diligence and everything else. It's just the KYC part, right? So that immediately for a firm like that to be able to do a $2 million transaction, the economics don't make sense. So therefore, for a financial institution, you need to take that number to $20 million for that entire transaction to be economically feasible for that financial institution, right? However, for base of the pyramid lending, it's very rare to have a $20 billion transaction size, right? Which is why you see institutions not participating in that in those smaller transactions, right? Via technology and the aggregation of lending portfolios, you can actually get it to that. You can actually get that scale, right? So in other words, you blend portfolios to be able to achieve that. And
Okay.
and and, and so one of the premises of having a tech platform and having all this, spending the time and the effort to build these facilitation pathways, is that
Right.
now you can effectively finance $2 million tickets as effectively as you did with $20 million tickets. You can also get smaller investors who, for example, would only invest $2 million. You can also get smaller investors who participate in such portfolios.
And these are qualified investors because not every
That is correct.
jurisdiction,
You cannot go.
because
You
they are
cannot.
high risk.
They are not rated portfolios. They're not officially. They don't have an official credit rating, right? They don't have the regulatory credit rating, etc.
Yeah, it's interesting because I've actually seen PA2P itself, being pushed in China here, and by different players. Some, go straight matching investors with borrowers directly and at a retail level. And some take that portfolio approach. At the retail level, it was very successful initially, but in a GDP that's growing at that time, 8 to 12%, and now this year at least it's 6%. 6% is still very good. You actually end up in a situation where you've got more investors than you have borrowers. And the quality of the borrowers, you actually need to do far more due diligence. You need to be far more, secure and defensive, in building the business. You're not an investment bank. You're not touching the portfolio. They don't go on your balance sheet. So you're not a fund manager, and so you're more like a service provider, to both sides of the equation. So how much of the actual business do you see, or do you only visit with them when they're distressed? And also, what are you seeing on the distress front in the markets that you serve as a result of the pandemic?
I would say what you call the consulting model, or whether you call it the facilitation model. I think capital markets have provided that utility function for since markets existed, right? And our role in that is to direct capital towards this, to these lesser known segments, right? We're not interested in helping people buy China sovereign bonds, right? That's not our business, right? Our business is to look at private loan portfolios that are being originated with high impact and attract institutional capital to it. Our ability to attract capital is measured by our own our own origination abilities, A, right? And B, the premise that I talked to you about, which is how do you reduce the cost and the throughput of this analysis, because this analysis needs to be done for every investor, right? No investor invests in blind pools. So the premise is that as you lower the average cost, the through cost, the throughput, you will attract more capital to the space in impact, which is our premise, which is our way of, let's call it, creating impact in this space. Now, the second question, unfortunately, is exactly where we are focusing on right now, because we see the necessity to finance these portfolios is what we see is the driving need of the current crisis, right? So what we've seen is that a lot of the portfolios that were originated in bull market times, you know, and you know, have obviously gone distressed in terms of proportions. These NPL numbers are high, and there is currently no institutional process via which you can deal with these NPLs, right? So the idea is, how do you create an ethical NPL management process for all these new portfolios that have been created in the last few years? How do you ensure that they are digested comfortably, and how do you ensure that these loans are worked out with minimum disruption to A, the individuals involved, and B, the economic conditions that prevail in these markets today,
Right.
right? And this is still very much an ongoing.
Well, what we're not getting is a true picture of what the fallout really is, and by country. So the fallout might well come over time. Countries releasing data showing that the NPLs are much higher than that the traditional institutions are stressed. And also the way in which they're capitalized. In fact, that's one conversation that I wanted to have with you on the investor side, right? And you were saying that investors, the nature of capital was different, before ESG and after ESG. Give us a sense of, some of these concepts that you use to attract investors, and maybe the reason that traditional institutions in the West might well be interested in investing in impact portfolios.
The global asset management industry today is $80 trillion. Right? Of this, and this is across all assets, right? In 2015, right, approximately 24% called itself ESG funds assets, right? So, and that's still a large number, but 24% of the industry had already tagged themselves with ESG labels, right? And they invest in conformity with some kind of policy, right? Environmental, social, and governance policy. Now, the bulk of this was avoidance. In other words, they would not invest in like tobacco or armaments, etc. But that branding was useful. As of 2020, 50% of the industry, 50, right, is ESG labeled. 5 years, what you've seen is the transformation of the entire asset management industry to go from, let's call it 1/4, right, or less than a quarter, like sustainably labeled, to 50% sustainability labeled, or pledging in some form or fashion that they will follow these policies. And if you look at the estimates of this, for example, there was a good Deutsche Bank report on ESG that said that they expect 90% of the industry to be ESG labeled by 2025. Why is this happening? One is the large wealth transfer that you're seeing in the West from the baby boomer generation to the millennials, right? So this is the largest wealth transfer in the history of the world, right? $24 trillion or so is in this decade is moving from the baby boomer generation to the millennial generation. And the millennial generation truly looks at and has a lens on capital, right? And their own lifestyles, that they believe in sustainability, right? They believe in kind of giving back to society, in kind of ensuring that they are responsible stewards of the planet and of the resources that they have seen come through, which is not true of our generation. If you look at private banks and at the studies that they've done, you see that millennials almost tend to have a much higher proportion of sustainably labeled assets in their own portfolios, in their own investing portfolios, as compared to earlier generations. Change that that will drive this through. The second thing is, of course, regulation, right? You can already see that there's regulation at the EU level. There are consultation papers out on, on differing capital standards for brown assets versus light green assets and blue assets. The next iteration of financial regulation is going to include sustainability metrics, right? The EU has the SFDR, the Sustainable Finance Disclosure Regulation, which will require all asset managers and financial advisors to classify the investment funds by March 2021. So it's not even in the future, it is now, right? Okay. And then you can see here, there are three categories: the gray, light green, and dark green. So if you're an asset manager in the European Union today, you will, by regulation, have to disclose what proportion of your assets conform to which category, right?
Yep.
So, and already the banks are putting in place, capital metrics, right? For this to come into risk-weighted assets as well. Okay. If you look at it in terms of factors, one, there's a massive awareness and a generational shift, right? And luckily the younger people today, are far more conscious of their own collective responsibilities than our generation was, right? And two is that you're seeing this rapidly being enshrined in regulatory environments, right? Now the US has, of course, under the present administration, gone backward in this space, right? But I expect, they will definitely pick up this bit once, the new administration comes in, in terms of how they regulate this space. I was conscious that this discussion was meant to be on non-performing loans. So you can see this is an S&P estimate for Asia Pacific NPAs and credit losses. And S&P estimates that NPAs can rise by 600 billion and credit losses in 2020 alone, just to be clear, this is not forward looking, right? This is just for this year alone, is 300 billion. And importantly, they predict a pretty severe hit to banking systems in emerging market countries. So for example, they rate India, Mexico, or South Africa that are going to take probably 4 years to even emerge with capitalization level, which is pre-crisis. And the developed market and the other markets are not that well either. So they're predicting that these markets will probably get there by 2023. That's the US, the UK, France, Australia, Brazil, and so on and so forth. So the numbers are pretty grim. And as you said, there's not a lot of regulatory discussion on this. There's not a lot of public policy discussion on actually how even post-crisis, how will this be mitigated? How will these systems be recapitalized, right? How will you ensure that capital is adequate to to kind of flow back into these economies and allow, because it's not just enough to print money, right, or monetize debt as people have been doing in this crisis.
And then you had another point related to that the quality of capital or the definition of capital will change as a result. And once you put in an ESG component, capital will look very different. A triple A rated capital will look different from a triple B rated capital because now there's this added component. And then the countries that actually benefit from this re-rating are no longer the developed, stable countries, but the countries where capital can make a difference on impact. So the whole character of capital changes as a result.
I agree with you. The earlier, the earlier microfinance lending that happened in India was quote unquote hot money, right? Like,
Yep.
money looking for financial return and with a very short time horizon, right? Like how fast can I get out? How fast can I flip it? And that causes issues, right? As you see these metrics come into mainstream finance, even at the institutional level and honestly at the bank level, this is very, very positive from a global EM perspective, right? Because this entire north-south divide, in a certain sense, has been about the exploitation of the southern economies, right? Natural resources going out, capital, because capital is scarce, you can command a premium for your capital, and that's how you play the value extraction game.
Yeah.
But more and more, and hopefully the sooner this happens, sooner this enshrined in regulation, you will see that people are paying more attention to this, and of course, this is a virtuous cycle, right? Once asset managers see that it's easier to raise capital with an ESG tag, right? And right now you are seeing, let's call it a little bit of cynical arbitration, cynical people in the space. They're like, oh, let's go raise money with an ESG, and then we'll do whatever we have to do with it, right? But increasingly that arbitrage will narrow, right? If
Right.
you are raising money with an ESG tag, well, there's going to be governance around that, right? And then you will have to ensure from a compliance and a reporting perspective that you are actually following the social objectives that you laid out. I think this is a really positive development and should be encouraged, is my point.
One last point that I want to test with you,
Sure.
which is that in traditional banking, and just taking off from the point about the way in which microfinance had evolved, traditional banking, has a formula in that both the asset and the liability side of the business should match each other in terms of accountability, in terms of the nature of both the assets and the liabilities. There's a kind of a dimension, a synergy between assets and liabilities, which is increasingly not necessarily related in capital markets and in the new forms of finance. So if you take a lot of the digital banks that have evolved in Europe today, they're all great on the liability side, and then they are hamstrung when it comes to the deploying on the asset side, right? And even when they do deploy it on the asset side, the issue is not so much how much they can raise or how cheaply they can raise, but who they raise it from. The accountability and so on. Otherwise, the business model just doesn't hold. And you are right now matching investors to distressed assets that are arising from today's pandemic and so on. Now, what sort of synergies or dynamism that you need to see between the investor and the assets being invested in in order to make this a long-term sustainable business model for yourself?
What you're seeing especially in the developed markets is that the neobanks have been focusing on the liability side of the balance sheets, right? They've been looking strong at attracting deposit money, right, via their regulated product and superior customer service and superior digital offerings. Okay, but once these capitals come on, they found it difficult to build the traditional side of the balance sheet. I would take a slightly more nuanced view on that, and actually take you back to the theory of why companies exist, right? Companies exist when the internal friction between transactions that is inside a company, right, is lower than the external friction. In other words, the company itself, within the company, internal transactions are take less effort to do, and therefore it makes sense to aggregate into companies and have a pool, right? Now, if you take that into the digital space, what you're seeing is the bucketing of specialized services and facilities. So the neobanks have proven themselves very strong at attracting deposit money on the liability side, right? As long as they can deploy this money externally without the same friction, right? Or with an equivalent internal friction that a JP Morgan does or a DBS does, right? The system as a whole is fine. So now the need of the hour, for example, with the neobanks, is to find those asset-only specialists that allow them to deploy the capital that has been raised from this particular branch of licensed institutions into the specialized lending institutions. Because increasingly, unless you're a too big to fail bank, you won't have both sides of it. right? You need to focus and you need to specialize. Even when you look at the large private wealth managers like in UBS or CS, their focus or what they're good at is attracting private banks and attracting private wealth and high net worth investors. They're not necessarily good on the asset deployment side. That's something they've had to create over the years. In fact, the premise for Credit Suisse taking over First Boston was exactly that they needed to deploy capital, right? There was too much capital on the Credit Suisse balance sheet that and they were deploying it to the First Boston franchise, right? But I would put to you the counter argument that in today's more transparent world and more tech-enabled world, you don't need to do this. You don't need to have the same institution doing both, right? As long as you can efficiently deploy this capital from one institution to the other via good capital market linkages.
Thank you very much for that. That's a very incredible insight that contributes to how we assess how the different players will evolve over time.